What's up everybody, I'm Jaspreet Singh, and the Federal Reserve Bank told us time and time again that our economy and our labor market is so strong that we can withstand higher interest rates and we can bring inflation down without hurting the economy through something called a soft landing. But now it's starting to look like you really need to buckle your seatbelts because the soft landing might not be so soft after all. According to a new report, we have some Federal Reserve Bank officials that are now saying that a recession is pretty much inevitable and that this whole idea of a soft landing is going to be nearly impossible. Now, if you've been subscribed to the minority mindset, this really shouldn't come as that big of a surprise, but if you've been trusting everything the government and the Federal Reserve Bank has said up until this point, this is going to be pretty shocking news. When the Fed first started raising interest rates, they talked about how raising interest rates would have no effect on the economy and markets, and the reason why they waited until 2022 to start raising interest rates instead of 2021 was because the Fed was waiting until our economy was strong enough, until our labor market was strong enough. And they said that because our economy is so strong and our labor market is so robust that we will be able to raise interest rates, which will cool down inflation, and this will not have a negative consequence on the economy, which is why they said that we could have this quote soft landing, meaning that borrowing money can become more expensive to cool inflation down without hurting the economy because our economy was so strong and people had so much money and everybody was doing so well financially that it would not affect the consumer or businesses or markets. But now we're starting to see that none of those things are coming true. People are really struggling because your cost of living is growing so much faster than the income that you're getting, and businesses are struggling because, well, they can't keep up with these higher costs and they can't keep up with selling products when you're in the slowing economy. And now you're seeing markets struggle as well. We're seeing the stock market get hurt, we're seeing cryptocurrency get hurt, even real estate is getting hurt because of the higher interest rates. And now today, with inflation still higher than ever and the economy continuing to slow down, the New York Federal Reserve Bank came out and said that there's virtually no chance now for a soft landing with our economy. With their newest calculations, they're saying that there is a 10% chance for a soft landing. Now, in order to understand what this means, you really have to understand what does a soft landing mean, because there is a technical definition for soft landing. A soft landing is if you look at the economy over the course of 10 quarters, meaning 2.5 years. So you break up a year into quarters, meaning 4 parts. So 10 quarters, if you look at these 10 quarters, you are not going to see a period of 4 quarters with a negative GDP together. That is the technical definition of a soft landing. And the way that the Fed has phrased it makes it so confusing to understand. I mean, it took me a lot of time for me to decipher their definition of a soft landing, to break it down into this. But what it ultimately comes down to, if you want the layman's terms of a soft landing, is 12 months of GDP growth by -1%. If you don't have anything worse than that, it is a soft landing. So as long as you don't have a year where the economy falls by more than 1%, it's a soft landing, and they try to confuse you with the real definition of it. However, if you see a year with the economy falling by more than 1%, it's considered a quote hard landing. And now what the New York Fed is saying is that over the next 2.5 years, there's only a 10% chance that we're going to see a soft landing. By the way, GDP is what we use to measure the growth of the economy. This brings me to the next question of, if it's not a soft landing, what is it going to be? Now, of course, we do talk about this in Market Briefs, which is my free financial newsletter that I created. If you have not joined Market Briefs yet, I highly recommend that you do that, because it is a daily breakdown of what's happening in the financial markets into a fun, witty, easy to read email. Even if you don't understand the complex terms that are happening in the financial news, Market Briefs breaks it down so it's super easy to understand, and it's fun to read. You'll understand the stock market, to the crypto market, to the real estate market, to inflation, to the global economy. So if you have not joined Market Briefs yet, you can do it for free, and I'll put the link to it down in the description below. This brings me to the question of, is our economy entering the S word? Stagflation. If you were thinking anything other than stagflation, get your mind out of the gutter. Stagflation is a weird type of economic downturn where on one hand you have high inflation and on the other hand you have high unemployment. You have a slowing economy and you have wages that are falling. And this is a very tough concept to really grasp because most of us have never experienced this, because the last time we saw any sort of stagflation was in the 1970s. And it's tough to understand because when you have high inflation, that means there's a lot of money in the market. markets. That's what we're seeing happen right now. In 2020 and 2021, the government and the Fed had injected trillions of dollars into our economy, into markets, into people, into businesses. And now we have all this money out there which is causing inflation, meaning it's the value of our dollar dropping, causing the price of things to go up. But if there's a lot of money in the economy, how can you see an economic downturn? Well, what can happen is if you do too much inflation, the inflation can lead to an economic slowdown. That's the issue that we're seeing right now, where the prices of things have gone up so high that people can't just afford their basic cost of living. They can't afford groceries. They can't afford their rent. They can't afford their car payment. They can't afford all the things that they could have before because the value of the earnings and their savings have dropped so much. And this is the situation that we're facing right now. However, we haven't got into the second side of the stagflation, which is the high unemployment. We're starting to see the economy slow down right now. We're starting to see companies do more hiring freezes. We're starting to see companies do more layoffs. But the concern is this going to continue? And the factor that's going to help determine that is what the Federal Reserve Bank does. Because right now, the Fed is working to fight inflation. That's why they've been raising interest rates so aggressively. They're raising interest rates to bring inflation down, because when you have inflation like this from the money printing, you need to tighten the monetary supply. And that's what they're doing by raising interest rates. That tightens the monetary supply, it pulls money out of the economy, and that slows down the economy. However, inflation has not started slowing down. So we're slowing down the economy, while inflation is still extremely high. Now the question is, what's going to break first? Is it going to be inflation, or is it going to be the economy? Right now, inflation is still very high. So inflation is still growing, inflation is still very high. However, the economy is going down. Now as the economy is going down, that means that jobs are going to come with it. Jobs are a lagging indicator because businesses don't want to lay people off or let people go unless they have no other option. And so if we start to see business profits fall, like we've been seeing happen, and then they start to cut costs, meaning they're going to need to lay people off, well, that could cause more unemployment. It could cause more layoffs. It could cause more bankruptcies. And so now this is the concern. Is that going to happen? And up until now, the Federal Reserve Bank and the government and economists have kept saying that there's no chance for stagflation. There's no chance that we could enter this type of stagflationary time. But they also said that inflation was transitory, that we're not going to see any sort of long-term, real sustained inflation. Yet here we are today with long-term sustained inflation. And at the same time, the Federal Reserve Bank kept telling us that we're going to see a soft landing, that we're not going to see much economic pain because our economy is so strong. And now we're starting to see the economy slow down. And then we've heard so many times that stagflation is not even a possibility. It's not even remotely possible. There's no chance of stagflation. Now here we are today, kind of getting worried about stagflation being a possibility. Because now as we raise interest rates, it makes doing business more expensive. It makes people borrow and spend less money because buying a home is more expensive, buying a car is more expensive. So people are spending less money, which hurts the economy, which hurts businesses, which means businesses may have to cut costs, which means we could see unemployment start to go up. So now what does this mean for you? Well, one, you need to be aware of what's happening, which is why we have market briefs, which is why if you haven't subscribed to market briefs yet, make sure you do that. But on the second hand, this is why you need to be financially educated, be prepared, that way you can take advantage of opportunities that come your way. So on the one hand, you want to make sure you protect yourself. Have cash put aside. Have some reserves put aside. That way, in case you do see anything happen to your income, that you can protect yourself, that way you're not running into credit card debt in case that happens. But on the flip side, you don't just want to be able to survive, you want to be able to thrive. Because anytime you see these types of volatile markets, anytime you see these types of economic slowdowns, it creates opportunities for investors. But the investors that can take advantage of these opportunities are the ones that are educated and the ones that are prepared. So this is where now you want to be preparing yourself, because if you see an asset that you like, stocks, real estate, crypto, gold, startups, whatever the business or the asset is that you like, when you see this asset go on sale, go on discount because of the economy, Everybody gets scared, everybody runs away, everybody tells you to sell, 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 but this is where you want to be coming in and buying, because then you can buy these assets at a discounted price. How do you find the good companies? Now this has to do with that sort of fundamental analysis, the fundamental research, where now you're looking into the actual numbers of a company. You're looking at the revenues, you're looking at the profits, you're looking at the executives, who runs the company, do you believe in them, do you trust them, do they do a good job? You're looking at the products, are they innovating? And you want to look at the growth.